In the next 8 days, I'll be taking you through a 4-part series on personal finance, and here's how it will go. Now, in the first part of this series, which is already out, I talked about the introduction to personal finance, and in that video, I explained everything you need to know about personal finance and why financial literacy is very important. So if you haven't seen that video or the part 1 of this series, the link to that video will be in the description below, or you check the link in the pinned comment of this video. And then in the second part of this series, which is already out too, I talked about how to make money and get rich. Now that video is a complete guide where you'll be able to learn everything on how to make money, both actively and passively, and even both online and offline. And in that video, I talked about different business ideas and money making ideas, and I also explained the step-by-step guide on how you can start and go ahead to make money from all of the ideas I mentioned in that video. Now the link to the part 2 of this series will also be in the description below, or you check the pinned comment of this video. Now the third part of this series, which is this video you're watching right now, I'm going to teach you how to invest your money. Now, I'll teach you the different kinds of investment you have out there and how you can start making money from each of these investments. I'll also teach you how to identify investment scams so that you don't fall for them. This part of this video is very, very important. So make sure you watch this video to the end so that you don't miss any important information. And then in the fourth part of this series, which is going to be the last one, I will teach you how to manage your money like the rich. Now in that video, you will learn the complete guide on what managing money is really all about. You also learn how to budget your money and how to plan your finances, and even how to save your money the right way. So if you are ready for these and you are ready to learn, please like this video and subscribe to the YouTube channel, and please turn on the notification bell so that you know when all of these videos are out. Thank you. Now let's get to the part 3 of this series. Under this section, I'll be talking about investment basics. I'll talk about long-term investing versus short-term investing. I'll talk about different investments you should know and how you can start. And then I'll talk about avoiding investment scams and how to protect your money. So let's get started. Now let's start with investment basics. Now what is an investment, or what is the meaning of investment? Now investment is the process of committing money to an asset or venture with the expectation of generating profit over time. So this means that you put money in an asset and that asset will make more money for you over time. That's the meaning of investing your money. Now investing helps you to grow wealth, beat inflation, and achieve your financial goals. Now, why should you invest your money? So why invest? Now, the first reason is wealth growth. Now, money invested can grow significantly over time. This means that if you invest your money in an asset today, that asset can make more money for you, and the money you get from that asset will make more money for you. So the investment will just be creating more money for you every day or every month or every year, and thereby growing wealth for you. Now, the second reason why you should invest is passive income. Now, some investment generate regular income, e.g. dividend interest. So for example, if you're investing in stocks that pay dividends, you get passive income for yourself. So that means that the investment is making money for you. Now, the third reason why you need to invest is beating inflation. Now, investing ensures your money retains value over time. So for example, if you have, let's say, $1,000 and you don't use that money for anything, you don't invest it, you just leave it in the bank, in 1 year to come or 2 years to come, that $1,000 will lose its value. And then another reason why you need to invest is financial security. It helps in retirement planning and achieving financial freedom. So these are the reasons why you need to be investing your money. Now, what are the different types of investments you should know? Now, for number 1, you have stocks. Now, investing in stocks means ownership in a company with potential for high returns, but also risk. So this means that you invest in a particular company and you become a passive owner in that company. That's just the meaning. And then you get returns when there's growth in the company or when the company makes money. That's just the meaning. And then another type of investment we have will be bonds. So bonds means you are lending money to a government or corporation with fixed interest returns. So if you're interested in bonds, you can just go to your bank and say you want to invest in government bonds. They will give you access to that and you just put your money and you get your returns. Now this kind of investment is a low risk investment where you just earn little returns on your money. So if you're looking for low risk investment, bonds will be the right one for you. Now the next one will be real estate. Real estate means buying property for rental income or appreciation. So this means that you buy rental properties and you rent them out to get passive income, or you just buy them and hold, and when they increase in value, you sell to make more money for yourself. And then another type of investment we have will be mutual funds and ETFs. So mutual funds are pooled investments that are managed by professionals. So mutual funds means a group of investments. So in a mutual funds, you can have different investments in it, and all of those investments are managed by professionals or by investment managers. And then you have commodities. Commodities means you are investing in assets like gold, silver, or oil. So you are investing in gold, silver, or oil. That means you are investing in commodities. And then the next one will be cryptocurrency. So these are digital assets with high volatility but potential growth. So you can invest in cryptocurrencies if you have the chance for high risk investment. And then you have high savings accounts. So high savings accounts are accounts where you can save your money and then you get high interest on your money. That's just what high interest savings account is all about. So these are different types of investment that you can invest your money in. Don't worry, I'll still be talking in depth about each of these types of investment, so make sure you keep watching and be patient. Now, the next thing we'll be talking about is key investment principles. What are the important principles you must understand about investing your money? Now, the first one will be risk versus return. Now, this means that higher returns often come with higher risk. This means that if you want to make more money from an investment, you must be able to take high risk. If you want to make low returns from an investment, then you go for low risk. That's just what this is telling you. So make sure you know that. That means that if you see any investment that is giving you high returns, have it at the back of your mind that it is a high risk investment. Now, the second principle you need to understand is diversification. This means spread your investments across different assets to minimize risk. So this means that if you want to invest your money, invest it in different assets. Don't invest your money in one asset. Don't go invest all your money in crypto or all your money in stocks. Make sure you put your money in different investment assets so that you can minimize risk. Now, the next principle will be long-term perspective. This means that investing is best when viewed over years, not weeks. So this means that if you want to invest your money and focus on reasonable returns, make sure that you're investing for long term. So make sure you're investing for 1 year, 2 years, 5 years, and so on. The next one will be compounding. Compounding means reinvesting earnings helps accelerate towards growth. So this means that, let's say for example, you invest in crypto, and if you make money from that crypto investment, the money you make from that crypto investment, you invest it back into that crypto or maybe to other cryptocurrencies, and then you use that money to make more money for yourself. So it's just like if the money you make, you use it to make more money, and that money you use it to make more money. So you'll be following that cycle, and your money will start making more money for you over time. And then market research is the last one. This means always understand what you are investing in. A lot of people want to invest in stocks, but yeah, they don't want to educate themselves about what the stock market is all about. A lot of people want to invest in cryptocurrencies, but yet they don't want to learn about what crypto is all about. All of these things are things you need to understand before you put in your money. So these are the key important principles you need to know about investing your money before you start. Now let's go into long-term investing versus short-term investing. Now, investing can be approached with different time horizons, primarily categorized into long-term investing and short-term investing. Now, each has its own strategies, risk, and rewards. Now, let's start with long-term investing. Now, what is the definition for long-term investing? Now, this means holding investment for an extended period, typically 5 years or more. And the objective of long-term investing is to build wealth over time through capital appreciation, compounding, and dividends. So this means that if you invest your money in an asset and you invest for like 5 years, 10 years, 15 years, that means that is a long-term investment. So you are looking to take profit from that investment after so many years. And the objective of this kind of investment is to build wealth through capital appreciation, that is when the asset increases in price, or through compounding, that is when the money you make keeps on making more money for you, or through dividends, that is you keep getting passive income from that investment. I hope you understand. So that's the definition and that's the objective of a long-term investment. Now, what are the key features of long-term investing? Now, the number one feature is compounding benefit. This means that your earnings are reinvested, leading to exponential growth. So I already explained this. I said the money you make, you use it to make more money, and that money you use it to make money, and your money will start making more money for you. That's the meaning of compounding benefit. Now, the next feature is less impact from market fluctuations. So this means that short-term volatility matters less as prices tend to rise over time. So what it's trying to tell you is that when market moves up and down, whether stocks or crypto, it doesn't affect you if you are doing long-term investing, because when market is moving up and down, it will eventually still come and move up and enter into your profit level. So you don't have to be bothered about short-term price movement in the market. Now, the next feature will be lower taxes and fees. Now, capital gains taxes are lower for long-term holdings. So this means that if you are investing for the long term, the tax or the trading fees you'll be paying will be very, very low. And then the next one will be passive approach. So this means that there's less frequent buying and selling, reducing emotional decision making. So it's not like the kind of investing where you will buy today, sell tomorrow, buy in another week, sell again. All of those things are not long-term investing. For long-term investing, you are not buying and selling frequently, so there's nothing like emotional decision that you are doing with your money. Now, what are the common long-term investment strategies? Now, the first one is to buy and hold. Now, this means investing in quality assets and holding them for years. So let's, for example, you want to invest in crypto, you can buy Bitcoin and hold for years. If it's ETH, you buy and hold for years. Or maybe if it's stocks, maybe you invest in a particular company and keep holding the stocks you buy in that company for years. So that's an example of buy and hold. Now, the second one is dollar cost averaging strategy. Now, this means investing a fixed amount regularly to average out market fluctuations. So if you are planning to do long-term investment, that means that, let's for example in crypto, this means that you can invest a fixed amount of money every week or every month into that asset for about 5 years or 10 years, or for as long as you want to keep investing in that asset. Or maybe if it's a particular stock, you can just pick that stock and invest, let's say $500 every month into that stock for as long as you want, maybe 5 years, 10 years. Just keep investing for as long as you want. The idea of doing this is that by the time the market is going up, you'll be making more money than the average person who has just been investing once in a while. So that is important. Now, the third one is through index fund investing. So this means that you're buying broad market funds like the S&P 500 for steady growth. So in case you don't know, index funds are funds that contain multiple stocks that you can use to diversify your investment. And as you can see right here, the S&P 500 is an example of an index fund. So this S&P 500 contains the top 500 stocks in the US. That's the meaning. So if you invest your money right here, it means you are diversifying your money into the top 500 stocks in the US. So investing your money in this will help you to diversify your money. And then the fourth one will be dividend investing. So this means that you are holding stocks that pay regular dividends for passive income. So this way you are making passive income for you, and your money or your investment is making money for you without you working, and you are making money while you are sleeping. So that is another strategy for long-term investment. Now, what are the different long-term investment options? Now, the first one will be stocks of well-established companies. So for this, you can invest in companies that are well-established or reputable companies. Don't just go and invest your money in just anyhow companies. That's if you are looking for long-term investment. Don't invest your money in just anyhow companies. Make sure the company you're investing in is a reputable and well-established company. Now, the number two is index funds and ETF. I made an example of the S&P 500 that has the top 500 stocks in the US. That's a perfect example for long-term investment. And number three will be bonds. So you can do this one for balanced risk. Like I said earlier, bonds are low-risk investment. And if you're interested in bonds, just go to your bank and tell them you want to invest in government bonds, and they will give you access to it. And you just get little interest on your money, but it is a low-risk investment. Your money is safe. And for number four, you have real estate. So for real estate, you buy a property and you keep renting it out and you keep holding it for as long as you want. And maybe after 10, 20, 30 years, you can now decide to sell that property and you make money for yourself. And number five will be cryptocurrencies. So for those with high risk tolerance, if you have high risk tolerance, you can invest your money in cryptocurrencies, because cryptocurrencies are high risk investment. So make sure you pick reputable cryptocurrencies like Bitcoin and Ethereum if you are looking for long-term investment with crypto. So these are different options for long-term investment. Now let's talk about short-term investing. Now, what's the definition? This means holding investment for a few days, few weeks, or few months to take advantage of quick price movement. So this means that you invest in, let's say, crypto today, and maybe in like 1 week, you sell it after it has gone up and you take your profit. Or maybe you invest in a particular stock today, and maybe after 2 weeks it has gone up, you sell it and you take your profit. Or maybe you buy an NFT today, and then after some days it has gone up in price and you sell it to make profit. Those are examples of short-term investment. Now, what is the objective of a short-term investment? It is to earn fast profit through price fluctuations and short-term trends. So if you are looking to earn fast profit from your investment, then focus on short-term investment. Now, what are the key features of short-term investing? Now, number one is quick profit potential. This means that your gains can be realized in a short period. So you can make your profit in a short period like 1 week, few days, or few months. And then number two is active management required. This means that it requires monitoring the market, if it's crypto or stocks, and making frequent trades. So you have to be trading frequently if you want to be making consistent profits with short-term investing. And number three is more liquidity. This means that it is easier to convert investments back to cash quickly. So if you're looking for an investment that will make you convert your money to cash easily, then go for short-term investment. Now, what are some common short-term investment strategies? Now, the first one will be day trading. So this means that you are buying and selling stocks, forex, or crypto within the same day. So this means that you buy a crypto today and maybe it goes up in price that same day, you sell it that same day and make profit. That's an example. Another one is swing trading. This means you are holding assets for a few days or few weeks to capitalize on price swings. So maybe you buy a crypto today or you buy a stock today and you hold it for like a week, and after it has gone up in profit for a week, you sell it and you make profit. And then the third one is scalping. So this means you are making multiple small trades for quick and tiny profits. So these are the three main strategies for short-term investment. Now, what are some examples of short-term investment? Now, number one will be stocks with high volatility. Now, if you find a stock that is going up with high volatility, then you can invest in that stock for short-term investment. So that kind of stock, you can just invest today, and after like maybe 2 days, 3 days, it goes up in price due to high volatility, you sell it and you take your profit. Now, number two will be cryptocurrencies. You can also do cryptocurrencies for short-term investment. So, for example, you can buy a coin today and maybe it goes up in price after 3 days. You sell it and you take your profits. Number three will be forex trading. So this one, you are investing in currencies, in foreign currencies. So when you buy foreign currencies and they go up in price, then you can sell them and take your profit also. That's forex trading. And then number four will be high yield savings account. This for lower risk short-term gains. So for example, you are looking to invest your money in a high yield savings account for like 3 months, 6 months, then you can do high yield savings account and you still get interest on your money. And then you have short-term government or corporate bonds. So I mentioned bonds in long-term investment. So you can also do short-term investment with bonds also. So you can also do all of this. So these are examples of short-term investment. Now, here are my final thoughts on long-term and short-term investing. Now, long-term investing is ideal for building sustainable wealth and it is less stressful. So if you are looking to build sustainable wealth in the long term, like 10 years, 15 years to come, then long-term investing will be good for you. But short-term investing can generate quick profit, but it comes with higher risk. So if you're the kind of person that you're looking to make quick profit right now with your investment, then short-term investing is the right one for you. But a balanced approach that is mixing both may be the best strategy for you depending on your goals and risk tolerance. So in summary, I would advise that you combine both together. So you have some of your money in short-term investment and you have some of your money in long-term investment. So that's the difference and everything you need to know about long-term investing and short-term investing. Now for the next section, we'll talk about the different investments you should know and how to start. Now, the first one will be stocks. Now, this means you are buying shares in a company, giving you partial ownership in that company. So, for example, you buy stocks in a particular company, it means you become a partial owner in that company. Now, what are the pros and cons of investing in stocks? Now, for the pros, you have high returns over time. This means that over time, you can make more money on your investment, and then you have passive income, that is dividends. In case you don't know, there are stocks that pay you dividends, that is they pay you profit regularly. So that profit can be a source of income for you. Now, the cons of investing in stocks will be that they are volatile, that is, they can lose value quickly. So if you're investing in stocks, the value of a stock can go down drastically. So if you invest in the wrong stock, you are putting yourself at risk of losing your money. Now, how do you start investing in stocks? Now, the first step is to open a brokerage account or use an investment app. That's the first step. And in case you are looking for a good brokerage account, just go to your browser and type brokerage account in my country. Then you can go to the brokerage account office and tell them you want to open the brokerage account to start investing in stocks, and they will start helping you invest in stocks. That's another way. Or if you don't want to go through that stress, just use an investment app. So just search for different investment apps in your country that can allow you to invest in stocks. Once you've done that, the next step is to research companies. That is, do your research on different companies that you can invest in, and then pick reputable individual stocks. So for me, I always invest in top companies in different industries, and that way I'm diversifying my money. So for example, I invest in top companies in the tech industry, I invest in top companies in the food industry, I invest in top companies in the pharmaceutical industries, I invest in top companies in the energy industry, I invest in top companies in the financial industries. These are the ways I diversify my investment in stocks, and I make sure I invest in something that I know will last for a very, very long time. So that's just the process of investing in stocks. Now, the second one will be ETFs, that is exchange traded funds. Now, this is a mix of stocks, bonds, or commodities traded like a stock. So ETFs, like I have explained earlier, is a combination of different stocks put together. And then I made mention of the S&P 500. As I said, S&P 500 contains the top 500 stocks in the US. So if you are investing in that ETF or in that index fund, you are investing your money in the top 500 stocks in the US. That's just the meaning. So there are so many examples of ETFs. Just go to your browser and browse for the one that is your country or the country you want to invest money in. Now, what are the pros of investing in ETFs? Number one is diversification. Like I said, ETFs is a combination of different stocks. So if you invest your money in an ETF, it means you are diversifying your money in different stocks. And then another pro is that it has lower risk than individual stocks. So if you're investing in individual stocks and you go and invest in the wrong stock, you are putting yourself at high risk of losing your money. But if you go and invest in ETFs, it means you are diversifying your money in different stocks. So if one stock is not doing well, others will do well and you can make money from the ones that are doing well. That's the meaning. But what are the cons of investing in ETFs? Now, the first one is that some fees apply. So for you to invest in some ETFs, you have to pay some fees. And another one is that it has limited upside compared to stocks. So for example, if you invest in a particular stock and it goes really up in price, you make so much money. But if that stock is in an ETF that you are investing in, if it goes up in price, but maybe other stocks in that ETF are not making so much money, you'll not be able to make so much money for yourself. So you see that it has both advantage and disadvantages. I hope you understand. Now, how do you start investing in ETFs? It is the same process of investing in stocks. Just invest through a brokerage or an investment app. Now, the third investment will be mutual funds. Now, mutual funds are professionally managed investment funds that pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. So mutual funds are similar to ETFs and index funds, but for mutual funds, you have different kinds of investments. In a mutual fund, you can have stocks, you can have bonds, and you can have other kinds of investment. So it's not limited to stocks alone. You can have other kinds of investment in a mutual fund, and it is being managed by investment managers. Now, what are the pros and cons of investing in mutual funds? Now, for the pros, it has lower risk due to diversification. Now, remember I said the mutual fund is a combination of different kinds of investment. So if you're investing your money in a mutual fund, it means you are diversifying your money in different investments. And another pro is that no need for active management. This means that you don't need to be managing the investment yourself. Just put your money in any investment app that offers mutual funds, and that investment app or the investment managers will help you manage your money. Now, the cons or the disadvantages are higher fees. For this, you have to be paying trading fees when you invest your money in mutual funds, and it has less control over individual stock choices. So for individual stock choices, you are the one who is picking the stocks you want to invest in, but for mutual funds, you are not the one picking the stocks you invest in. It is being managed by the investment managers. Now, how do you start investing in mutual funds? You can start by investing through fund managers. So what you can just do is to look for maybe fund firms or investment firms, that is firms that help people manage their money. Just give them your money and they will help you manage your money with mutual funds. Or you can do this with banks. There are banks that offer mutual funds. Just go to a bank, tell them that you want to invest in mutual funds, and they will give you access to it. And another way is to invest through financial advisors. So if you don't need financial advisor out there, just reach out to the person and the person will help you on how to invest with mutual funds. Now, the fourth way to invest your money will be through bonds. Now, bonds means you are lending money to a company or government for a fixed interest return. So this means that you are borrowing the government your money or maybe a company your money, and then they give you a fixed interest on your money. Now, what are the pros and cons? Now, the pros or the advantages are, number one, it is safe. So your money is guaranteed. It is a low-risk investment. You are not at risk of losing your money at all. And the second advantage is that it has predictable returns. So you can know how much you are making from that investment. Once you go to a bank and say you want to invest in bonds, they will tell you, oh, this is the percentage you will be getting, maybe 10%, 15%, 20%. It can vary. So again, it has predictable returns. You know how much you will make. And the third advantage is that it is good for long-term stability. This means that if you are looking for a long-term investment that is stable, then you can invest in bonds. But the disadvantage is that it has lower returns compared to stocks and other investments. So the returns you get from bonds are very low, and that is why they are safe investments. Now, how do you start? You can buy through government or corporate bonds market. And the easiest way to do this is to just go to your bank and tell them, oh, I want to invest in bonds, and they will give you access to this. Now, the next one will be real estate investment. Now, this means buying property to rent out for monthly income. That means you buy a property now, you rent it out to people, and they start paying you monthly income or yearly income. Now, what are the pros or advantages? Now, the first one is passive income. So this means that you just buy a property once, and that property you buy will be making money for you. Another advantage is property value appreciation. So this means that if you buy it now, that property will appreciate in value, and when you want to sell, maybe after like 5 years, 10 years, you sell and make profit for yourself. Now, what are the cons or what are the disadvantages? Number one is that it requires capital. You need so much money to invest in real estate before you can start making passive income for yourself. Number two is management effort. You need to be managing the property, or if you can just employ people to be managing the property for yourself, that is better. And the next one is tenant risk. There are so many tenants that will give you problems if you rent your properties out to them. Now, how do you start this? Now, you can research property locations and look for a very good location to buy your investment property. And the next thing is to secure financing. That is, look for money, find money on how you want to buy that property, and find tenants to rent the property to. It's as simple as that. Or you can just use fractional real estate investments. So this means that you come together with, let's say, 10 people, 5 people, 20 people, and you people bring money together to buy an investment property, and then that property will be making passive income for every one of you. That is what is called fractional real estate investment. So if you don't have all the money at once, just look for people to come together with you and you do fractional real estate investment. Now the next one will be real estate investment trust, which is called REIT. Now REIT means you're investing in companies that own real estate. So for this kind of investment, you're not investing in the property yourself. So you're investing in the real estate company that owns the property. That's just the meaning. So what this means is that you go to a real estate company, you give them money, and then they invest the money in their real estate properties or their real estate investments, and then your own is to just get passive income. That is just all you have to do. Now, what are the advantages and disadvantages? Now, the advantage of this one is that there is no need to own any property. So you don't need to own any property. You don't need to care about managing any property. Just invest your money. And the second advantage is passive income. So for this one, again, you're not doing anything. Just give them your money to invest and then they give you passive income. Now, the cons or the disadvantages will be that you don't own the property. So if you're the kind of person that you wish to own the property, if you are doing this, you won't be owning the property. You are just investing. And the second thing is that it is not managed by you. So if you're the kind of person that you want to own a real estate investment that is managed by you yourself, then this one is not for you. So REIT is not for you. Now, how do you start this? You can buy REIT through brokerage account. So again, just like I said, just look for the brokerage account around you and invest in REIT through them. Or you can just find any real estate investment company in your city or in your country and reach out to them that you want to invest in some of their properties, and then they give you access to it. And that is all. It's as simple as that. Now, number 7 will be cryptocurrencies. Now, cryptocurrencies are digital assets like Bitcoin and Ethereum. So these are assets that you invest your money in, and when they go up in price, you make money. So what are the advantages and disadvantages of investing in crypto? So the advantage will be high growth potential. Now, cryptocurrencies can really go up in price. In a month, you can make 50% profit from a crypto. You can make 20% profit in a crypto. You can make high profit from a crypto in a short period of time. The second advantage is decentralized finance opportunities. So this means that crypto is not controlled by anybody, so it is decentralized, and that means that it has huge potential. Now, the cons or the disadvantages will be extremely volatile. This means that cryptocurrencies can go really up and really down. So if you're investing in crypto, this means that you should be ready for high volatility. It can really go down. You can lose like 10%, 20% of your money in a day, in 2 days, and so on like that. And another disadvantage will be regulatory risk. Now, the reason I'm putting regulatory risk is that crypto is not yet regulated, and because of that, it is a high-risk investment if you want to do it. Now, how do you start investing in crypto? Number 1, open an account on crypto exchanges. So you can open an account on Bybit, BitGet, BingeX, Binance, and so on. And then the next thing is to pick reputable coins and invest only what you can afford to lose. If you're a beginner, pick reputable coins like Bitcoin and Ethereum. Don't start picking meme coins that will make you lose all your money in a day or in 2 days or in 1 week. Pick reputable coins and start from there and start investing only what you can afford to lose. The next investment will be commodities. So you have gold, silver, and oil. These 3 commodities are investments that you can put your money into. Now, what are the advantages? The advantages of investing in commodities will be hedged against inflation. So this means that if you invest your money in these commodities, you can beat inflation. Your money can grow in value. And the second advantage is that it is stable during market crashes. So even when the financial market is crashing, all of these commodities can stay at the top right there. But the disadvantages are prices can be unpredictable. Now, today they can tell you that the price of gold is this. Tomorrow they can tell you that it has gone really down. In the next day they can tell you that it has gone really up. So the prices can be unpredictable. And the second advantage is that there is no passive income with commodities. So if you're investing in commodities, no passive income. You're just buying and holding. Now, how do you start investing in commodities? You can buy commodities through commodity exchanges or ETFs. In case you don't know what commodity exchanges are, just go online and type best commodity exchanges and to bring out all the commodity exchanges that you can use for this. So that's the 8th way to invest your money. Now, for number 9, you have private equity and startups. This means that you are investing in new businesses or startups. So this means that if you see a company that is growing out there and you see that, oh, this company has potential, then you can invest your money in that company. Now, what is the advantage of doing this? The advantage is that it has high returns if the company succeeds. So if you invest your money in, like, let's say 3 companies and maybe one of the companies succeeds, you can make so much money that will be more than what you've invested in the 3 companies. Now, the disadvantage will be high risk. Now, this is a high risk investment. You can see in the example I gave, I said you can invest your money in 3 startups and only one will succeed. So you can see that it is a high risk investment. There are some times that you invest your money in different startups and none of them will succeed. It has happened before. Now, you also have long lockup periods. Now, what I mean by this is before you can make your profit from investing in businesses or startups, it can take long period of time. So it's not something you invest now and make money after a month or 2 months. No, it can take years. It can take 5 years, 6 years, up to 10 years. So it is like that. Now, how do you start investing in startups? Now, you can use platforms like AngelList. So if you go on this website called AngelList, just go on your browser and type it. You'll see the different ways that you can invest in startups on the website. Or you can just invest directly in businesses. So if you know a particular business that is doing well and has potential, you can just meet with the management of the company and tell them you want to invest in that business or in that company. So that's another way you can invest your money. Now, the next one will be collectibles and NFTs. So this means that you're investing your money in art, rare items, and digital assets. And what are the advantages and disadvantages? Now, the advantage for this is that it can appreciate over time. So this means that if you buy an art or you buy NFT right now, if you hold it for like 3 months or maybe a year, it can grow over time and you make your money when you sell it. Now, the disadvantages is that it is hard to value. So it is hard to put a value on an NFT or an art. It is very, very hard to value all of those things. And the market demand can fluctuate. So today you can hear that, oh, this art, a lot of people are buying it, a lot of people are demanding for it. And when you buy it, the next day, you see that nobody wants to buy it from you anymore. So you just have to hold it till when you see someone that will buy it. So market demand can fluctuate. Now, how do you start investing in NFTs or collectibles? Now, you can buy from marketplaces like OpenSea, that's for NFTs. So if you want to invest in NFTs, just buy through OpenSea, or you can use auction houses for physical collectibles. Like if you want to buy art or rare items, you can go to auction houses to invest in all of those things. All of these things are investments that you can do. Now, for number 11, which is the last one, you have high interest savings account. So these are savings accounts that offer higher than average interest rate on your deposit. So for example, if you have money, just deposit it on any high interest savings account and they will be giving you interest on your money. Not just any high interest on your money. Now, what are the advantages? The first one will be low risk. So these are low risk investments where your money and your profit are guaranteed. And then you have instant liquidity. So this means that you can easily remove your money anytime. And then you earn more than regular savings account. So when you're putting your money in high interest savings account, you are earning more returns more than regular savings account. And then the disadvantage for this investment will be that you get lower returns than investment like stocks and real estate. So the returns are always kind of small compared to stocks, real estate, or even crypto. Now, how do you start investing in high interest savings account? Now, the first thing is to open an account with a bank or online financial institution offering competitive interest rate. Now, when you are looking for one, look for the one with no fees, the one with high APY, that is high annual percentage yield, and the one where you can have easy access to your funds. So that's what you should be looking at when you are looking for high interest savings accounts to invest your money. So now that you know the different investments you can do out there, let's talk about avoiding investment scams and how to protect your money. This is very important. Now, investment scams are designed to trick you into handing over your money with promises of high returns and little to no risk. Now, as an investor, it is important to recognize the warning signs and protect yourself from fraud. And here's how. Now, before I show you how to avoid investment scams and how to protect your money, you need to understand that investment scams are investment where they will tell you that you will get 50% in 1 month, 100% in 1 month, and they will tell you that your money is safe. Anything like that, it is a scam. It is a very big scam. So please avoid it. Now, here's how you can avoid investment scams and how to protect your money. Now, the first common type of investment scam will be Ponzi schemes. So Ponzi scheme is a scam where money from new investors is used to pay older investors instead of generating real profit. So for this kind of investment, what they do is they'll say, oh, come and invest on our platform. We will give you 100% in a month. And when you invest your money, they'll tell you for you to make more money, you have to refer people. Now, when they tell you to refer people, you yourself, you go and refer people because you want to make more money. And then the money they get from the new people who are investing, they use it to pay you. And that is how they continue that cycle where they use new investors' money to pay old investors. So I hope you see that it is a scam. It is not a real investment. Now, the red flags you will see to identify this kind of scam is guaranteed high returns with no risk. So if they say come and invest and you get 100% returns in a month with no risk, run. Now, the second one will be no clear business model or products. So let's assume that for the investment company, they don't have any investment product, they don't have any business model to make profit. If they don't have any of these, then it is a scam. Now, the third one will be pressure to recruit more investors. If they are giving you pressure or pressurizing you to go and recruit more investors or to refer more people to the platform, then you should know that this is a scam. It's a big scam. So that's the first type of scam you should be aware of. Now, the second one will be pyramid schemes. Now, this is a fraudulent system where investors make more money by recruiting others rather than through legitimate investment. Now, this is similar to Ponzi schemes, but for this one, the only thing you are doing is multi-level marketing. So it's just like you come on this platform, you make a payment, they'll tell you to refer more people, you go and refer 2 more people, those 2 more people will refer 2 more people, those 2 more people will refer 2 more people. So you see that the chain is going up and up and up, and as the chain is going up and up and up, you are making money for yourself. But the truth is that kind of investment is a scam. There's nothing there. It is a big scam, so avoid it. And the red flags you receive for this will be focus on recruiting instead of selling products or services. So if they tell you that the only thing you just be doing is just to recruit people to the platform, it is a scam. Now, the second one will be money flows to top-level participants. That is, if the people who make the most money from this investment are people at the top, that is, maybe people who started from the very beginning, then it is a big scam. And the third one is if there is no real investment or business operations, then it is a scam. So that's for number 2. Now, the third type of investment scam will be pump and dump scams. Now, scammers artificially inflate the price of a stock or cryptocurrency by spreading false hype. Then they sell their holdings at a profit before the price crashes. So I'll give you an example. An example is when maybe someone is about to release a coin, they will come online, they will hype the coin, they will pay influencers to hype the coin and make everyone to buy. And then when they see that the price is going up, because when more people buy a particular coin, the price will really go up. And then when the price goes really up, the people who created the coin and the influencers, they will quickly sell their cryptocurrencies and make profit, while you that you have been deceived to come and invest in that coin, you will be left with little to nothing of your money. So it has happened a lot in the crypto space and it is still happening, but you need to be very careful. Now, what are the red flags you will see to identify this? The first one is sudden hype around a little known asset. So for example, an asset that just came out of nowhere, there's a sudden hype around it, then you should be suspicious. Now, number 2 will be spam messages promoting the next big thing. So for example, if you are getting spam messages on your social media platforms or in your phone and they are telling you that, oh, this is the next big thing, this is the next Apple, this is the next Bitcoin, this is the next Ethereum, all of those things are just to promote scams. Now, the third one will be rapid price increase followed by a sharp drop. So for example, if there's a rapid price increase in a cryptocurrency or in a stock and then you just see a sharp drop immediately, that is a scam. So you need to be very, very careful. Now, the fourth one will be advance fee fraud. Now, this is a common fraud that people do. Now, a scam where fraudsters ask for an upfront payment in exchange for access to an exclusive investment opportunity. So for this one, people will come to you, or these scammers, they will come to you and tell you, oh, we have an investment opportunity for you, but before you can have access to this exclusive investment, you must pay an upfront payment. Maybe they'll tell you to pay like $1,000, $500 or thereabout. If you are doing that, that is a scam. It's a very big scam. There are some people that maybe they are doing airdrops. They will tell you that before you can get access to the airdrop, you must pay an upfront payment of maybe $10, $50. All of those things are scams. And the red flags you will see are requests for upfront fees. So if they tell you to pay any upfront payment, avoid it. It is a scam. And number 2 is if there is no verifiable track record for that investment, it is a scam. And number 3 is claims of special access to opportunity. So if they claim that they have special access to investment opportunity, then be careful. Be very, very careful. Now, number 5 will be fake investment platforms. Now, fraudulent websites or apps that look like real trading platforms but disappear after collecting investors' money. This one has happened to a lot of people, whereby they invest their money and after some days, the investment platform would disappear and they won't be able to retrieve their money again. Now, the red flags you will see for this will be poor website security or design. If the security or the design of the website is very bad, then you need to be suspicious. The second one will be no regulation or company registration details. So if it's showing you that the company is not registered, is not regulated in the country where you are investing that money, run for your life. Now, the third one will be difficulty withdrawing your funds. Now, if you have difficulty withdrawing your funds, or maybe you see reviews from other people that have used the investment platform and they keep saying, oh, they have difficulties withdrawing their money, then run from that investment platform. So these are the different kinds of scams that you can find out there. Make sure you avoid all of these investment scams and protect your money. So that's everything you need to learn about investing your money and avoiding investment scams. Now, if you've learned something new from this video or maybe something important from this video, please let me know in the comment section below. Now, in the part 4 of this series, which will be in the next video, I will teach you how to manage your money like the rich. Now, like I said earlier, in that video, you will learn the complete guide on what managing money is really all about. You learn how to budget your money, how to plan your finances, and even how to save your money the right way. And I'm sure you definitely don't want to miss that. So make sure you like this video, subscribe to the YouTube channel, and please turn on the notification bell so you know when the video is out. And just in case by the time you are watching this video, maybe the part 4 of this series is out, then the part 4 of this series will be on my right side right here. Just click on it. And the part 2 of this series will be on my left side right here. Thank you for watching. I'll see you in the part 4 video. Bye.